Hello, everyone. Dear students, can you please confirm me? Am I clearly audible and visible to all of you? Awaiting your acknowledgement. Are we good to go? Perfect. Dear students, I welcome you all to today's live session. Hello, everyone. Assalamu alaikum to everyone. I hope every one of you is doing great. And as discussed in the last session, the orientation session, I shared the schedule of live classes, and according to that schedule, we would be proceeding on towards our course, towards the coverage of our course, and accordingly, we will be starting with learning objective A today, which is regulatory environment. I hope you have got that planner of live classes. Is it? I hope you have got the planner. You have got hold of the planner. I will also share in the WhatsApp group. Perfect. So as we know, the course is divided into multiple learning objectives, and I also focused and emphasized the importance of various learning objectives. Starting with the very first one, this learning objective is not very important from examination point of view, but still a few bits and pieces come in every alternative attempt, especially from the ACCA 250, which is relating to the laws and regulations in audit, the consideration for laws and regulations in an audit of historical financial information. Specifically, that ACCA, various elements are periodically tested. Not a full-fledged question, obviously, but still, this learning objective has its role play in various previous attempts. And after 2-3 attempts, we see some parts from money laundering as well. So obviously, as our target is to comprehensively and thoroughly cover this course, so we cannot risk losing anything. So starting from the very first learning objective, which is regulatory environment. Okay, so what are the areas which are covered in this learning objective? First of all, we'll be discussing about audit regulators and their role in the audit industry. Even before that, we will be discussing about what is an audit. We will start from the basic. We'll start from very basic concept. What is an audit? Okay. Then we'll discuss about the importance of regulations in the audit industry. Who are the audit regulators? What role do they play? Why is the need of audit regulators to intervene? We will also have a look at corporate governance aspects, specifically audit committees. We'll see what money laundering is, what is the process of money laundering, obviously not with the objective to launder money, but with the objective to spot it on during our audit exercise. And in the learning objective, last but not the least, laws and regulations surrounding the audit client, that's ACCA 250, ACCA 250. Okay. So first of all, let us have a look at what an audit is. Obviously, this is not a new thing for us. You have already appeared for audit and assurance examination, and you have even cleared it. And that's why you are sitting for advanced audit and assurance. But still, let us have a quick recall what an audit is. An audit is an official examination of the accounts or the accounting systems of an entity by an auditor. And we say examination of accounts, financial statements. Obviously, we know when we talk about financial statements, the financial statements contains all the elements of financial statements, including a statement of financial position, a statement of profit and loss, statement of comprehensive income, statement of changes in equity, statement of cash flows, and notes. Everything. When we talk about financial statements, we talk about all these elements of the financial statements. So what is an audit? Basically, auditor is examining the set of these financial statements. And why is the auditor examining this set of financial statements at all? Well, the objective of the audit is to enable an auditor to convey an opinion whether the financial statements are prepared according to applicable financial reporting framework. And plus, they present true and fair view. Why there is a need to even give an opinion whether the financial statements present true and fair view? This is because the business is usually run by the directors, by the management of the company. And in a big company, those who are running the company are different than those who are owning the company, the shareholders. So, whatever affairs of the company are being run by the directors, shareholders are not aware of that. And the management presents those affairs in the form of the financial statements, financial information. That financial statement may be misleading. There could be hanky-pankies in that financial statement. There could be misstatements in that financial statements. And there have been incidents where there have been corporate frauds. Misleading information was being presented to the shareholders, and the shareholders didn't have a clue what's going on. And one fine morning, the entire weak structure of the company collapsed. So what auditor does? Auditor basically adds trust to that financial statements. Auditor adds trust to that process. Auditor reviews that set of financial statements and gives the opinion that these financial statements present true and fair view. That's confidence. That's called assurance. So in an assurance engagement, and an audit is an assurance engagement, we all know this. In an assurance engagement, an assurance firm is engaged by one party to give an opinion on a piece of information that has been prepared by another party. And we know that in audit, shareholders engage auditor. Shareholders request auditor, please have a look at this financial information. Please have a look at this financial statements. Give us the opinion whether it's okay or not. And our opinion is directed to the shareholders of the company. Therefore, if you recall, the heading of the report is Independent Auditor's Report to the shareholders of the company. What are the elements of assurance engagement? 5 elements. 3-party relationship. Who are those parties? Practitioner, the audit practitioner, the one who is practicing the audit. Who is that? The assurance provider, the service provider firm. Responsible party, the one who is preparing the financial statements. Intended users, for example, in case of an audit, shareholders. Practitioner, in case of audit, the auditor or audit firm. Responsible party, directors or management. And intended users, obviously, in case of an audit, these are the shareholders. Subject matter, the information which is under audit or review. Suitable criteria, the benchmark against which those set of financials are being audited. For example, IFRS, applicable reporting financial framework, IFRS. Evidence, and obviously, opinion cannot be given in any error. We need some evidence to verify things. We need documentary evidences. We need to vouch those evidences. We need to verify those evidences. Whether the numbers which are made in the financial statements are supported by the relevant documents. Assurance report. the report, the opinion given by the auditor is called assurance report. That's in the prescribed format as prescribed by the standards, and shareholders get hold of that report, and that's the main deliverable of the audit firm. We talk about the audit. What are the types of assurances? Broadly speaking, two types of assurances: reasonable assurance. Audit is an example of reasonable assurance in which we do a lot of testing. We'll look at this later in detail when we will be actually comparing the audit exercise with the review exercise. But obviously, in audit, we are carrying out a lot of testing because our opinion is a detailed one as compared to the review opinion. Our assurance, our reliance on the numbers, on the financial statements is higher because we are testing more. So we are placing more reliance, or our opinion is asking shareholders that, yes, you can place a lot of reliance on these numbers because we have tested a lot. Limited assurance. For example, a review assignment, interim review. Limited procedures are performed, and hence the opinion is also called a negative opinion because that opinion in itself, the wordings itself, does not provide a positive opinion, and a lower level of assurance, a lower level of confidence is conveyed to the shareholders. We already discussed what's the need of regulation of audit and assurance. What's the need for regulation of audit and assurance? Why audit needs to be regularized? Why there should be checks and balances on audit itself? Because we have seen audit itself, audit exercise itself, a check and balance exercise on what is being reported by the management. But what is the need to have a check and balance on this audit process? Let's see. So assurance provider give an impartial, professional view on issues that matter to users of financial statements and other information. It is important that this view can be trusted. Why would shareholders trust auditors' opinion? Because they know that these are the auditors. These are being governed by a few bodies, and few bodies are having checks and balances on the auditor's conduct, that they are doing or they are verifying it properly or not. Whether they are following the required standards or not, be it ethical standards, be it professional standards, be it legal standards, anything. Are you getting this? Therefore, assurance providers need to operate within ethical boundaries. And yes, we know that lots of ethical regulations are attracted on chartered accountants. They need to follow the consistent standards, the professional standards, professional regulations. For example, IFRS. For example, international standards on auditing. And whatever they do should be in the boundaries of local laws and regulations. There are local laws and regulations attracted to the auditors' conduct. For example, here in Pakistan, we have Companies Act. Securities and Exchange Commission of Pakistan is the main regulator, and ACCA is also looking at this process. We have ICAP, supervisory body. We'll be discussing it in a while. Necessary regulations. So what are the actual regulations which are applicable on the auditors? Number one, there are ethical regulations which are applicable on the auditors. So assurance providers are given ethical guidance by professional bodies, for example, ACCA Code of Ethics. Not only the professional bodies, but the law also envisages various laws which needs to be complied. For example, Code of Corporate Governance. There are ethical guidelines in Code of Corporate Governance, and it varies from jurisdiction to jurisdiction, because every jurisdiction might have their own specific corporate governance requirements. International Federation of Accountants, a body that sets auditing standards, how you should audit. So they also lay down the ethical guidelines. Are you getting this? So all these ethical regulations are applicable on the auditor. We will be discussing these ethical considerations in very detailed manner in the upcoming learning objective. But just to give a brief heads up, although you have already studied in your previous studies, there are lots of ethical guidelines on the auditor's conduct, on the auditor's objectivity, various threats which may interfere in an unbiased opinion are specifically focused and monitors, scrutinized through microscope, and we see what are the threats, what are the safeguards, how to reduce, how to eliminate threats. And the similar discussion is coming your way in the upcoming learning objective as well. Legal regulations, laws, local laws, regulations. Most countries have legal requirements associated with some assurance providers, particularly auditors, because obviously auditors are placing trust in the process of relying the financial statements. And this, if you look at it closely, this is a very integral pillar, because if the auditor is not strengthening the credibility of those figures, shareholders might not be relying. Companies might be misreporting, an overall picture distorted, share price distorted, overall economic impact distorted. So local regulations are UK Companies Act 2017 in Pakistan, Banking Companies Ordinance here locally, etc. Then we have professional regulations. Professional regulations, we know international standards in auditing, which governs auditing guidelines. Okay. In depth, step by step, from planning to completion, review, and reporting, detailed auditing guidelines are there. Who are the regulators? We have seen what are the regulations, but who are the regulators? The bodies who are regulating this process. First of all, audit supervisory body, recognized audit supervisory body. For example, ACCA or ICAW in UK, Institute of Chartered Accountants of Pakistan in Pakistan, Institute of Chartered Accountants of India in India. Chartered accountant needs to be a member of a recognized supervisory body to obtain the audit rights. And as you are going through the curriculum, as you are studying this regulation, as you are studying these standards, you'll pass through this rigorous process. And once you pass your examinations, once you fulfill and comply your CPD requirements, your experience requirements, then only you'll be awarded the designation of an ACCA member, the prestigious qualification, designatory letters. RSB ensures auditors are suitably qualified. They monitor the behavior and quality control of their services. Then we have another regulator, International Standards Setting Body. What they do, they set the standards for conducting the audit, standard guidelines, so that the work carried out across the board, across the globe, meets certain quality or parameters, standards, so that the opinion can be relied upon. International Audit and Assurance Board sets international audit standards. Countries have either adopted these in full or based on their own audit standards, because local regulations also play a lot of an integral part. They also interfere. Many accounting or auditing standards, the local regulations override those standards, and obviously the local requirements, regulations need to be followed. IASB is the part of the International Federation of Accountants. IFAC is the global organization for accounting profession. And a small diagram is there on your screens. IFAC and then IASB and International Ethics Board. So International Audit and Assurance Board and IESBA is also part of IFAC. Then there come local regulatory authorities. Local regulatory authorities. Regulatory authority established under the laws of the country to supervise the audit and reporting process, as I already discussed. SCCP in Pakistan. Okay, first in UK and ACCP in Pakistan. Then we have Public Oversight Board, Audit Oversight Board. It's an additional check and balance, specifically for those entities which are public interest entities. Okay, so this board or these authorities or these boards aim to provide assurance and strengthen the public confidence. Extraordinary check, extraordinary vigilance. Because suppose if it's a listed company, if it's a bank, if it's an insurance company, if it's a public sector company, so the interest of masses is involved. So obviously they need some extra check and balance, extra regulation. So this audit oversight board improves the audit monitoring process. Then we have corporate governance regulations. It varies from jurisdiction to jurisdiction, but the broad principle remains the same. The corporate governance is about ensuring that public companies are managed effectively for the benefit of the company and its shareholders. So corporate governance requirements in most of the jurisdiction, and in fact in all the jurisdictions, are applicable in the listed companies, public interest entities. Okay. So what are the good corporate governance requirements? What do we mean by corporate governance? Okay. One thing we understood that corporate governance, as the name implies, governing the corporation, and the one who governs the corporation is sitting at the top with a fair perspective, unbiased perspective. Getting? Therefore, we say that audit committee is an integral part of the corporate governance. Corporate governance means if you are having audit committee, they are the one responsible for this governance. So good corporate governance requires fair appraisal of performance, fair remuneration and benefits, support and oversight of management by non-executive directors, the independent directors, so that they can have an independent look, and they can have an independent assessment whether the affairs are going okay or not. Fair financial reporting. The audit committee should have a financial reporting expert as well, so that they can oversee the financial reporting process as well. Whether whatever the financial reporting elements or aspects are going on, are they being run and managed effectively and efficiently or not? Audit committee should be having a look at it. Constructive relationship with the shareholders, effective management, sound system of internal controls. And as I told you, the integral part of audit committee, corporate governance, are audit committees. Okay, in most of the jurisdiction, must for listed entities. Because corporate governance regulations are compulsorily applicable in the listed entities. Getting? Because as I told you, interest of masses, interest of public is involved. It's not a closed group of family running the business. It's public at large. Okay. What are the key objectives? Increasing in public confidence, credibility, and objectivity of the published financial information. Because when the audit committee is involved, the audit committee is also having a check and balance on the figures and the numbers. The senior members are closely looking at numbers, discussing every nook and corner of those numbers. The process is bound to refine this information. Assisting directors in meeting their responsibilities in respect of financial reporting. Obviously, when the directors know that non-executive directors are sitting in audit committee, and they will be asking questions from us, what this has happened, what you have done this, what is this adjustment all about? We have to be answerable to them. So they will be more responsible, more accountable. Is strengthening the independence of the external auditor, because external auditor has direct access to the audit committee. Are you getting this? And the enforcement, the best enforcement come from the top. For example, any matter is stuck. You're not getting any evidence. Management is not responding to you in any issue, any significant misstatement. They are not responding, they're not rectifying it. Auditor has direct access to audit committees. Auditor can report it there. And this is the biggest fear for the management. Getting? Main functions. What are the main functions? They also review the internal control procedures. Even they review the internal audit department's activities, external auditors' results, their observations, or review of external auditors' results to ensure audit has been carried out efficiently and effectively. And they can even ask the questions from the auditors. Did you perform procedure on this area? Because we feel this is a risky one. Even if the auditor is not assuming a specific area to be risky, and if the audit committee members are emphasizing or focusing on that portion, auditor is bound to have some procedures performed in that area as well. Recommending remuneration and nomination of auditors. Obviously, we know the audit committee recommends the auditors. They propose a remuneration of the auditors. Reviewing requirements satisfied under UK corporate governance code or in any other corporate governance code in any other jurisdiction. Review of internal audit function. What are the advantages? Obviously, independent team, experienced team, having an oversight of the affairs, having check and balance, benefits all over. Improving quality of accounting, improved communication between external auditors and management, avoid conflicts between external auditors, management, lies in between, or internal and external audit, and things like that. But what are the disadvantages? Okay. Fear purpose to catch out management. What does it mean? The deterrence. Management is also a bit deterred. Okay? Bit deterred. They feel, okay, this audit committee or these non-executive directors are always there to pinpoint us, overburdening the non-executive directors. Non-executive directors are already there, making a separate committee might be seen as burdening them further. May lead to two-tier board, obviously. One, those who are executive and those who are non-executive. There might be some, what you can say, some cold war between these two. Costly, obviously. Yes, because obviously we need to pay for every meeting to all of the directors who are attending the meeting. Are you getting this? So I hope things are clear to this extent. Your acknowledgement will help me to move further. So can you please acknowledge me? Is everything crystal clear? Although this is not a very technical discussion, but since this is part of our course, so we are bound to skim this. Is it crystal clear till now? Perfect. Now comes the discussion of money laundering. Okay, so you haven't started this aspect earlier in your studies. This might be something new for you. Why this has been covered under the heading of laws and regulations? Because lots of laws and regulations are attracted to curb money laundering. What money laundering is and why there are many laws and regulations behind this activity. Let's have a look at it. Okay. So money laundering is the process of hiding the true origin of funds by passing the funds through a series of transactions to make it look as it came through legitimate sources. What does that mean? Okay. You have money, you have some funds, and those funds have not been earned legitimately. The source of fund is fishy. What do you mean by source of fund is fishy? You might have earned it from an illegal mean, not allowed in law. This might be the proceeds of any crime, proceeds of any theft, any illegal smuggling, or any other activity which is barred by law. So now these funds are in your hands. So if these are in our hands, how can anyone question? How will anyone get to know that I'm having these funds? Okay, I'll tell you. Let's see another definition. Process by which criminal attempts to conceal the true origin and ownership of the proceeds generated by illegal means. Not only conceal, but to look it clean as well. This statement is very important. Not only conceal it, but now my next step, my next motto will be to show that these funds have came from legitimate sources. That's the question mark. That's the challenge. How we do this? Before moving on to this, why there is a need to do this? Suppose if I have funds in my hands, I have cash in my hand, I have funds in my hands, and there is no one to ask, I'll not tell anyone that I have $1 million of black money, $1 million of fishy money, illegal money. I'll not tell anyone. Okay, perfectly fine. You won't tell anyone. Because I'm having this money in a bag which I've kept at my home. Perfectly fine. But the problem is, I cannot spend this entire amount in groceries, dine outs and hangouts. Because when there's a big sum of money, the wants increases, the needs increases, the luxuries increases. So I might be looking for a big house. I might be looking for a nice new car, isn't it? Or I might be looking to deposit it in a bank so that I can book a ticket for an international trip. All these activities need a hefty amount. I cannot spend cash. Suppose I've got hold of illegal money. I cannot spend all the amount in cash. For example, I'm going to a showroom to book a car. They'll ask to pay through banking channel. And suppose if my money is illegal, it's not coming through legitimate sources. I'm having it in cash. How can I pay them? Okay. So there are a few authorities which do not accept cash. They only say that we need banking instrument. We need the money through banking channel. And if this is illegal proceeds, if these are the proceeds of crime, how can you deposit it in the bank? How can you transfer it into the bank? And how can you pay it through the bank? So what you need to do is that, for example, person A has $1 million or $2 million of illegal money, and he is now planning to make it look clean so that these funds can be utilized, so that these funds can be channelized. Now, what is the process to launder it, to wash it, laundry? That's a very common terminology. Clothes are laundered, clothes are clean, washed. So the money is laundered, basically the black money, the questionable money, the fishy money is now being laundered. That means it's being processed, it's being cleaned in a washing machine, called a money laundering washing machine. And after that process, the clean money or the clean source will be displayed. So in many countries, the definition is even broader. We'll see how this process takes place. In many countries, the definition is even broader. And possessing or transferring the proceeds of any crime can be money laundering. Money saved from regulatory breaches, tax evaded money. Okay, so and this is in fact the case. Your black money is not only the money which you have earned through illegal sources, but that amount on which you haven't paid taxes. You have evaded tax. The amount which you have saved from regulatory breaches. All these amounts are, in the eyes of laws, illegal. And any means which you will be opting to clean this amount is illegal, and that's called money laundering. What's the money laundering process? How the money is laundered? Okay, so I'm not teaching you with the intention that you launder the money in the future for yourself. The purpose of teaching this is okay, just hold on for a while. The purpose of teaching this is that when an auditor is auditing the entity and when the auditor is looking at the affairs of the company, books of the company, transactions of the company, then if the auditor is trained, if auditor knows this process, if auditor has in its mind what my responsibilities are, then auditor will always be vigilant and alert any indication or any a clue of money laundering which is received during the course of audit. So money laundering process, placing. So first step is placing. Now, what does that mean? Introducing the funds into a business, probably in small cash amount, so as not to arouse suspicion. Okay. I'm placing the funds. I have illegal money with me. I have a bag of illegal money with me containing $10 million. Now I have to legalize it. I have to clean its source so that I can spend it on big objectives. I can buy a nice Mercedes. I can buy a home downtown. Okay. So what I need to do now, I need to clean the source of money, legitimize the source of money, so that if anybody asks me from where this amount came, I can show, okay, through this channel it came. Placing. So introducing the funds into a business. You open a business and you start placing funds in that business in small cash amounts so that no big amount is deposited and it doesn't come upfront in the eyes of the regulatory authorities. Otherwise, regulators will ask, what are you doing? What are you doing? And why are you doing like this? Or suppose, okay, let's read this and then I'll further explain you. Possible methods would be changing it into a different currency using small foreign exchange brokers or the bank, placing bets with it, take the currency to a country where fewer questions asked, put into the company and claim it as a cash sale. This is what usually happens. The money is laundered through service-based businesses, cash-based businesses. For example, one can open a gym. A gym has been opened. It is opened on a floor. It could be any floor. Okay, who cares? And there could be a register of members, and fake members could be registered there. Mr. Wilson has paid $1,000 per month for gym services, but there's no Mr. Wilson. Mr. Wilson doesn't exist. Are you getting this? So that's easy. We register fake members, we deposit fake fee, and that fake fee is available in the form of bags, black money. We deposit the service fee in the official bank account. So this amount now is starting getting cleaned. Service-based business, tuition centers, gymnasiums, etc. So service-based businesses, cash-based businesses are more likely to prone to this menace of money laundering. Then, once you have played small amounts in the business bank account, now came the process of layering. What does that mean? This simply means that you rotate the transactions, that you create a complex chain of transaction, transferring to that account, transferring to this account, then transferring to that account, then back to this account, then back to my account. So you create a complex chain of transaction. So even if the regulator tries to identify the source of the transaction, the regulator is puzzled. This is called layering. Moving the money around, creating complex chain of transactions, making it difficult for, okay, I think something is hidden. Okay. So moving the money around the complex chain of transactions, making it difficult to follow, difficult to trace. If you put a money into a company on Monday and then paid yourself a bonus on Tuesday, it would not take much for an investigator to link the two things together. Okay. But layering involves moving the money around by switching countries, buying and selling investments, generally trying to create a trail that is long so that no one dares to follow it. Are you getting this? Then comes integration, withdrawing so-called clean money from the business. And once the amount is clean, you can withdraw. For layering, let's take another example. For example, a small amount of fee is deposited through gymnasium. And now it won't happen that you pick up the entire sum and transfer to your account. You place it in a company, you lend it to someone, you purchase shares of another company, then basically even you purchase the shares in any other country where there are low taxes. Are you getting this? Tax-free zones. And then you rechannelize it again to the home country. Main purpose, to hide the true source of the transaction, true source of the money, true trail of the money. Okay. Integration. What does integration means? Withdrawing the so-called clean money from the business. And once the money is clean, once the money is okay, fit, layered, place, layer, and then integration. Now, check this out and meet your objectives. Money laundering. There are multiple legislation. If you talk about UK Criminal Justice Act, Terrorism Act, Proceeds of Crime Act, money laundering regulations, international money laundering regulations, many regulations are there. Offenses. Okay. Money laundering is itself a very big offense. Tipping off. Suppose I'm auditing the client, my team is auditing the client. I should give them sufficient training. Because suppose if by having look at the documentation or transactions, suppose any of these staff is feeling that the money has been laundered or the client is involved in money laundering, then we should train the staff that through none of your conduct should give this impression that you are suspicious about the money laundering offense. Don't give any clue to the client. They may even harm you. Offenses, not setting up procedures. Suppose my firm, my chartered accountancy firm, I have not set procedures for money laundering reporting. That's a weakening on my part. I am responsible to set up the procedures. Okay, that's an offense if I've not. And now the regulatory, the recognized supervisory body are very much following up in respect of money laundering regulations. It's talking specifically from Pakistan context. Not complying with the procedures, whatever the money laundering procedures are, not complying it. Duties. What's the main duty? Do client due diligence. Know your client. Know your client. What they're doing, when they're doing, from where they're earning the amount, their average turnover, their annual turnover, their wealth. Know your client, in which industry they are working. Appointing an MLRO. That's very important. Money laundering reporting officer. It's compulsory here in Pakistan for every firm to appoint MLRO, money laundering reporting officer. Because suppose if any of my team members has identified any money laundering offense, and in determining whether is it really a money laundering offense or not, we need an expert. It's called money laundering reporting officer, a senior in the firm, partner level in the firm, partner level resource in the firm, a partner in the firm. Getting? Okay. We need to train staff so that they don't tip off. They don't convey their apprehension that this might have been laundered. This is a fishy transaction. And once money laundering reporting officer is in place, suppose if any money laundering concern or suspicion has arose, the money laundering reporting officer will report to the external authority. Team will first internally report to money laundering reporting officer. The channel should be the team member reporting to their direct senior, the direct senior reporting to their direct partner. That direct partner will be discussing with the money laundering reporting officer, another peer partner in the firm. Getting this? And if this offense is really serious and it is 99% confirmed that yes, this is a money laundering offense, we need to communicate to external authority. How can you do the due diligence for an individual? Okay, due diligence, what does due diligence mean? Knowing your client, know what they're doing. Who are they? If it's a salaried person, it has a salary of, for example, $600,000 per year, and he is depositing $1 million per month. Why? Talking from bank's perspective. Why? So the banks should ask the client, why are you depositing such a big amount? So again, since we are establishing a relationship with the client. So before entering into the relationship, before even accepting the client, or suppose if we even have accepted and we are performing procedures, we should perform due diligence procedures, client identification procedures. Primarily, these procedures are carried out before accepting, before acceptance. Okay. Establish the client's full name and address. We should know. Examine their utility bills, their driving license, their passports. Are they all maintained? Are they fully equipped from these regulatory requirements? For a company, obtain copies of the following from registrar: certificate of incorporation, register of directors, register of members, shareholders, registered address. Who are the directors? What is the background check? Search the Google for their background checks. Have there been any allegations in past? Have there been any trust issues with the government? If these are the cases, the due diligence might not be that green, might not be that encouraging. And for a trust, you should examine the trust deed, know about the trustees, who are the trustees, what is the purpose of the trust, sources of funding. You should know where the money, from where the money is coming and from where it is. So, sorry, as far as the clients are concerned, who are the clients, whether are they trustworthy or not, or is there something problematic, some issue, some hanky-panky? If yes, then it's better to not continue the audit. Okay, not accept that audit. If you have indications that client might be involved in money laundering offenses, the directors are a politically exposed person, don't accept it then. What could be the potentially suspicious transactions? How can you spot on suspicious transactions? Okay. Suppose you're an audit team member and you're looking at the affairs of the company, transactions of the company. How can you be so sure that, yes, this is a fishy transaction? This is a suspicious transaction. Transaction that pass through several companies or countries, especially when there is no obvious reason. Amount is going on, one country, another country, and then back to us for no reason. Multiple small transactions of similar nature rather than one large individual transaction, like as it was discussed. Currency is changed, amount is converted into lower denomination foreign currency, and they utilize it. The creation of complicated group of companies when a simpler solution appeared to exist. That's again a very common phenomenon. The parent company has established 6 group companies. And whenever they need to increase, the parent company need to increase the sale, they give a bulk quantity to any of their group companies, and the group companies have to accept it because they're giving it on credit. But it's still, the parent company might be showing it as their sale. Okay. the creation of complicated group of companies when a simpler solution appears to exist, the creation of new company that is never actually used to trade, no trading, simply amount rotation, amount channelizing, amount rotating. Okay, I hope everything is crystal clear up till now. Is it? Creation of a new company that is never actually used to trade, just a company, actually no trading, no actual trading, but due to intercompany transactions, we are booking transactions and we need to inflate the sale, we are reversing in the next period, we are playing with the numbers and we are using this company to play with the numbers. A client under tax investigation, as I told you, if the client is under tax investigation, the client has hidden the proceeds. The client has hidden the proceeds and has not paid tax on it. And if the client has not paid tax on it, I told you, again, there's the black money. Okay. And whenever this money will be utilized in the official channel, question will come up from the regulatory authorities from where this amount has been earned. And then it will be very difficult for you to justify the source. Are you getting this? So, client, if the client is under tax investigation, it's an indication that there must be something fishy. So, trigger or alarm has risen. Client making facilitation payments, making bribe payments. This is an indication that client is laundering money because from where they are paying the bribe amount, they might have lots of black money in place as well. Or they are using this grease money to facilitate the process, which is wrong. So client making facilitation payments bribe to help smoothen certain transaction, paying an official a fee to ensure a contract is won. And that illegal fee is paid from illegal money. Or if not from illegal money, the process is illegal. You are bribing it and then you're winning the contract. If later down the line it's revealed that this was through a malified process, you gone, your reputation gone, your contract gone, everything lost. Having clients in political positions makes them politically exposed person. Those persons who are politically exposed, who are involved in politics, or whose relatives are involved in politics, have the power to enrich themselves with public money. So there might be some inclination towards corruption in them, and that corruption money might be used to clean up, to launder, okay, and problems could be identified. Cash-based businesses have always been a favorite for money launderers. As I already told you, service-based businesses, cash-based businesses, okay, they can easily claim the sale revenue, and when the next period arrive, they can reverse it back, or even they claim the sale revenue, fraudulent sale revenue, uh, whereas it's not the real money. Okay, cash-based businesses, from where the cash came, I did a lot of sale today. This is not actually the case. The markets were closed today, but still we're saying that we have done a lot of sale today because no one is there to verify. Simple. Okay. So money laundering is up. Any question, any concerns, any doubts, you are free to ask me. Everyone. If it's crystal clear, please acknowledge me. I'll move on. Great. Okay. Laws and regulations. Now, that's a very interesting topic, a short topic, but interesting topic. And the last topic of today's session, consideration of laws and regulations. Auditor is going to audit the entity. Auditor will plan the audit of the entity. But do you think that auditor should be well versed with all the laws and regulations governing a company? For example, suppose if auditor is going to audit pharmaceutical company. Now there are lots and lots of regulations which are applicable on this pharma company. Tax laws, health and safety laws, Drugs Act, the medicine manufacturing law, labor laws, environmental laws, and the list goes on. Do you think auditor is supposed to have a grip over all the laws and regulations which are applicable on the entity? I'm asking you. Please do respond. What do you think? Is auditor supposed to have a knowledge of all the laws and regulations? Very good. No. And it's very difficult for the auditor to have a grip over all the laws and regulations. But don't you think there should be a minimum benchmark, minimum standard that at least these laws, auditor should at least know these laws? If not the complete law, at least the relevant provisions where there might be some financial implications. Okay. Some numbers where there are some numbers are involved, where there are penalties in, where there are cash outflows involved. Getting this? So this is the established principle that auditor cannot know the laws, the applicable laws better than the entities. And here we are not binding auditor to know every nitty-gritty of every law applicable to the company. No. Let's see what are the objectives of this standard and what are the responsibilities of the auditor as far as compliance with laws and regulations are concerned. Because obviously, auditor is coming to audit the historical financial information once the year has passed. If suppose we talk about year 2023, then auditor will be coming at this stage, ideally. Auditor might be coming at this stage, ideally, to audit. So the non-compliances of the entire year have already been done. The damage has been done. So is it the only consideration of the auditor, or is the management also responsible to take care of these laws and regulations? Obviously, this is the first and foremost responsibility of the management and directors to consider the laws and regulations. Are you getting this? See, directors' responsibilities and auditors' responsibilities, management responsibilities. So first of all, they are the one who are responsible to ensure that the entity complies with all the relevant regulations and legislations. Then they are responsible to establish effective arrangements for preventing, detecting the non-compliances. It's the management who should tell which laws have been non-complied, which laws have been violated, because they are the one who are running the company. They are the one who should know in the first place which law has been violated. So they are the one who should come to you and tell you that, dear Mr. Auditor, during the year, this wrong thing has happened. this non-compliance has been executed. Guide, what are we supposed to do? So it should be the management who in the first place should have the knowledge of uh, this non-compliance. Getting this? What are the auditor's responsibilities? Auditor's main responsibility is to obtain reasonable assurance. Reasonable assurance, it's not absolute assurance. This testing is not 100% testing, it's reasonable assurance. We cover a lot of portion, but not everything. So if everything is not covered, we cannot be so sure about everything. So therefore, these words are used. Reasonable assurance. To obtain reasonable assurance that financial statements are free from material statements. What else objective? To obtain sufficient and appropriate audit evidence regarding compliance with those laws and regulations. This is very important. Though those laws and regulations which are recognized to have direct effect on the material amount and disclosure of the financial statements. Okay. So this is the auditor's responsibility to obtain sufficient and appropriate evidence. And before evidence, auditor need to obtain understanding. Then relevant evidence for any issue which may have direct financial impact on the financial statements. For example, the non-compliance is of taxation. So we know, we being tax experts know what would be the penalty. Are you getting this? Even those laws, for example, health and safety regulations. So at least we can go through that portion where there are fines and penalties have been discussed. Because there could be a possibility that entity might have hidden those. Are you getting this? The third one, to perform specified audit procedures to help identify instances of non-compliance. Okay, an auditor is supposed to carry out certain procedures so that the non-compliances could be identified, which are having material impact on the financial statements. We will see what do we mean by material impact. Okay, so this is call for prayers in my background. So I'll be taking 1 minute silence break till this azan ends. Okay. 10 to 15 minutes, 10 minutes more. The session will be further go for 10 minutes. So don't worry about that. We'll be ending in next 10 to 12 minutes. Stay tuned. I'll be resuming after the call for prayers. Okay. So auditor is responsible to perform specified procedures, and we'll see what are those specified procedures which auditors are required to perform to help identify the instances of non-compliances. We'll see. to respond appropriately if non-compliance is identified or suspected. So auditors should obtain reasonable assurance that everything is okay, the financials are free from material misstatement. Auditors should have knowledge and should obtain evidence in relation to those laws which are expected to have financial impact. Yes, Amina, this session will be, the recording will be available to you. And I've already shared the planner with all of you. And live classes will be executed as per that planner, and you will be having access to those live classes before result. No worries. So you can have the access of these classes, do attend these classes, and you can register yourself as well. Okay, great. And then auditor will be required to perform specified procedures to identify the instances of non-compliances. We'll have a look at it. What are those procedures? And once the non-compliance is identified, then what to do, what responses to opt for, what to do, who to whom to communicate, and things like that. So what are the procedures? What are the procedures? What are the specified procedures? First of all, obtain a general understanding of what the legal regulatory framework is. Inspect the correspondence of the legal authorities, because legal authorities might have sent notices for any non-compliances, imposing penalties. So go and inspect those notices, see those correspondence. Inquire the management. What do they know about a non-compliance? Has there been non-compliance in their knowledge? Ask them. If they tell, further dig into it. Consider the result of other audit procedures. For example, expense vouching. If expense vouching, you see a penalty. Oh, so this penalty might be linked to a non-compliance. Okay, so what is the non-compliance? Let's ask. Obtaining written confirmation from director that they have disclosed you all possible situations, because they are the one in the first place who are responsible for undoing this non-compliance, controlling this non-compliance. Okay, they are the one in the first place who are responsible to ensure the compliance. Are you getting this? So they should know and they should tell you what have been the non-compliances. What will be the procedures if non-compliances have been identified? Ask management about the penalties which have been imposed. How much? Again, inspect correspondence with the regulatory authorities. Inspect board minutes. You can get clues there. What have been the outflows? What have been the penalties? What could be the implication? Okay. And you can also inquire the company's legal counsel, the legal department, internal legal department. What are the non-compliances? What are the likelihoods of penalties? And things like that. Okay. If there has been non-compliances, we have performed the procedures. There has been non-compliance. What to do? Communicate to the management. Ask them, accounted for properly. If there has been breach, for example, if there has been any breach, notice has been received from regulatory authorities, penalty is probable, there is a present obligation, amount, a certain reliability, ask the management to book the provision, to do whatever is needed, basically. Tell the management and those charged with governance and ask them to do what is needed. Is it needed to book the penalty? Is it needed to disclose it? Whatever is needed, do whatever is needed. Okay. Adjust, disclose, whatever you recommend they should do. To shareholders, in the next step, if they don't do it, if they don't adjust it, okay, telling management, and if management is not doing, tell to those graduate governance audit committee. Even if this problem is not solving, then there you have no other option but to tell this to the shareholders in the audit report. Consider implication on audit opinion. Modify it. It could be a qualified opinion. We will see when we go to the opinion section later in the course. Third parties, if there is a need, you might also be required to communicate this to the third parties, to the regulator. For example, for example, suppose you get to know during the course of audit that your company is a plastic toy manufacturer and they're using any harmful chemical. Okay, they're using any harmful chemical, and that harmful chemical might be injurious to the health of the children. So, what would be your obligation? What would be your responsibility? You're in a fix. Take legal advice, because if you tell to the client, you might be in danger. Are you getting this? You might be in danger. So, what will be you supposed to do? Okay, so this is one para. Okay. So, this is the situation where you need to report the non-compliance to the external regulator. Are you getting this? Suppose you're ordering a pharmaceutical company and you get to know that a raw material used in a drug, in a medicine, that's illegal and that's harmful to the health of the users. That's harmful. And the company is doing it intentionally. What are you going to do? Take the legal advice, communicate to the regulatory authority. Okay. So third parties need to bear in mind duty of confidentiality, but also duty to public interest. If it's in the public interest, if it's if it is for the people, if it is for the good of the people, and your legal advisor suggests, go for it. Report to the external authority, and withdrawal from engagement as a last resort after taking legal opinion. If there is no remedial action or there are doubts over management's integrity, no option left but to withdraw from the engagement. Getting? So this is it. I've summarized regulatory environment for you. We have discussed all the important aspects. I hope you enjoyed the session. I hope that you had a good insight of all these topics. Was not a very technical one, easy one, a discursive one, but exam questions or bits of exam questions are there in the past exams from money laundering, from laws and regulations, and they can come up in your attempt as well. So it's always good to have everything in the kitty, summarize, conceptual discussion, done, dusted, backed up. Okay. So thank you so very much, dear students. Thank you for attending this session. I hope you enjoyed it. See you in the next session. That's on Tuesday, on coming Tuesday. I'll share the link in the group. Be part of the group. If you're not part of the group, you can text me. You already have my number. Okay. Let me write my number here as well. It's if you're not part of the group, text me. I'll make you part of the group and I'll sharing links, slides, and this material in that. Thank you so very much. Take care a lot. May Almighty bless you all. See you in the next session on upcoming Tuesday. Your tutor signing off. Okay, Michael, I don't get your point. Is it the recording in good time? You will get the recording. Don't worry. I don't get your point actually. You'll get the recording as well, but the timings of the session have already been communicated. Try to attend live, or else you will have the access of the recording. Okay. Thank you so very much. Take care a lot. Bye bye.